Hit it.
Wait, hold on a second. I have a fucking.
Oh wait, I wrote Tuesday.
Yeah, no shit. I was about to read Tuesday. I'm like fucking Ron Burgundy. Like, you can leave this in there. Actually,
yeah, you can. Hit it.
It's Friday, July 7, 2023, episode 216. I'm Patrick Ceresna.
And I'm Kevin Muir. Well, I'm back from a couple of weeks in Japan, and we are producing this off-cycle show to get caught up on all the action in the markets that I've missed. We have no guests, so it's just Patrick and myself, but don't fret. We'll soon be back to our regular scheduled programming with a bunch of great new guests lined up for the summer schedule. In the meantime, we'll start with talking charts with our very own resident technical analyst guru, Patrick Ceresna, who will finally answer the question, is the bottom of the sea filled with boats whose captains didn't believe in charts, or is the sea bottom littered with those who relied on them too much?
Ouch. All right. And then we end with the no stupid questions and skin in the game. And folks, stick around. We might even drink some beers along the way. Normally, I invite Lena to hop on to tell what beer I'm drinking. But today, at least in this episode, I'm doing it on her own. I am drinking the Innis and Gunn oak aged beer.
I am too, actually. This is a rare instance where we both have the beer.
Well, cheers, but let's try this out. Ooh, that is nice. Actually, that's pleasant. It's a very nice beer. All right, Kev, give us some side effects, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include podcast infidelity, the wagyu wobbles or wobblies, and then this is something I suffer from, the receding trend line.
Oh, that's a nasty one. All right. Let's talk some charts, buddy.
All right. What do you got for us, Patrick?
All right. Let's start off 3 weeks ago, because we had a little gap there. We had just we were watching whether the peak pain trade capitulation was going to happen, whether the global PMIs were going to be misses, and then we were looking at whether there was going to be some post FOMC market volatility. Well, I'll tell you, there was market volatility, but to the upside. Volatility it was, but it certainly wasn't a break on the downside. What do you take away from the last couple of weeks?
Well, I think we finally got that squeeze that people that had all been on the sideline expecting the market to roll over, the recession bros, as we like to call them. They finally seem to capitulate and say, it's not coming and it's time to buy some stocks.
Yeah, and I want to talk about that when we get to some charts, but let's talk about the top three things to watch in just the next 1 week, because we are actually going to go back to our normal schedule, so there will be another episode soon. So just next week, we have the Bank of Canada, the monetary policy. Is there anything you're watching here in Canada?
Well, no, we had a blowout number in Canada in terms of the employment today. It was 60,000 jobs were made, and generally Canada's just roughly a tenth the size of America. So that would be like 600,000 jobs be made in the US. Canada's flying. We've had some weakness in the currency recently, but now with this huge jobs number, it looks like the Bank of Canada will be back on the schedule to be hiking again.
Wow. Well, let's see whether they can pull that off. Number two, I had to squeeze it in there, bud. The US dollar.
God. This is what happens when I don't get to, a say in it.
No, actually, look, I'm not here to pump some U.S. dollar bull Kool-Aid. I just when look at it, was a substantial 80-cent breakdown today on the after the jobs numbers from yesterday and today. Significant reversal, but basically the rally throughout the second half of June saw the dollar index only muster up a rally back towards 103.5, which is dead into the Fibonacci zones, and it was just like a rising wedge formation. And I was saying to my members all week long that we needed to see a breakout above this 103.50 if the dollar was going to have any stab on the upside. And instead it rejected with this breakdown. The dollar is vulnerable for going for a full retest of those April-May lows at 101. And who knows whether maybe even dabbles with the 100 level. The interesting thing about that, Kev, is that it's now lining up for some weakness. Why? Because, okay, the euro broke out. The euro was in this little bull flag formation, held very well. I mean, we did in order for it to have any legitimate new downtrend, we would have needed to see proper breaks of 108 and start weakening. Instead, held in there for weeks and now attempting to bull breakout. But look at that pound sterling, almost making a fresh new high for the year. A nice clean bull flag. What were its previous highs acted as support. Coming right back up. So we had the European currencies doing very well, including the Canadian dollar, that was doing very well. Same type of a pattern. But what was interesting is that the US dollar muddle was really driven by Asian currencies. And what we had was that US dollar yen, after pretty much 3 months of a relentless US dollar rise against the yen. This is probably one of the clearest breaks on the of this trend that we have seen in the 3 months. And the thing is that, well, if all the other currencies are all strong and the US dollar's weak and suddenly the yen breaks, this creates a condition that may very well send that US dollar right back down to its lows. I don't know whether it's a new downtrend, but it's very hard to make a bull argument here on the dollar at all. What are your thoughts on what I just said?
Well, I love that yen chart because it was the perfect timing for me in Japan.
You sized up the situation real hand. Like you did some scouting.
You know what it was? I had a little chat with the Bank of Japan Governor Ueda. I think I'm saying that right. And I said, listen, if you're going to intervene or you're going to get this
wait till you get back home.
Why don't you wait until till I'm back home? And he was nice enough. He said, sure, for you. I know you're a big spender. We'll make it so your trip to Japan is cheap. Anyways, no, kidding aside, I agree. This was a big day for the US dollar, and it just it goes to show you how much attitudes can change with one, decisive market action. Because if you had asked most people kind of earlier in the week, they were leaning all towards US dollar strength. I kept hearing about the milkshake again. If I have to hear about that bloody milkshake again, do you think he regrets the milkshake? Because it's just so annoying. Like it's like whenever he
made it sticky. It was a sticky milkshake, and now everyone.
And I just think it's overused. And every time the U.S. dollar gets a little bit of a bid, people start talking about the U.S. dollar milkshake. Yeah. No, it's like it's not going to be this melt up of the U.S. dollar every time it goes up, and it's not going to be, on the same token, a collapse in the dollar every time it goes down. Now, most of the time we just meander around, and there's some moves within there, and it's neither one of these. And that's kind of the frustrating thing about either side of those camps is that it's just so dramatically like one way.
What I do though want to say, okay, like you're pointing out the dollar thing element that way, which I get. But what I want to highlight though is I continue to be a huge supporter of the idea that intermarket analysis and the impact of the U.S. dollar on different asset classes is real, and it's still relevant, even though it will evolve over time. And one of the things that it will be really interesting is that if we go through a dollar weakness cycle, will that light a match under gold? Will we see generally commodities have an upcycle during this kind of a period? I think there's all sorts of different things that might come around if this U.S. dollar breakdown engages. One day doesn't make a new trend. This was one big down day, and I don't want to already advertise to our listeners that this is like a certainty, but it's not. You can't ignore it. If we go through any sustained dollar downdraft, we'll be curious whether the commodities actually finally get a spark lit under their asses, and we see an advance here on some of these things that have been beaten down so badly.
Yeah, and I think you're also right to highlight that it was the Asian currencies. And they've been the ones that have kind of experienced it the worst. And there's a lot of talk now about this carry trade being back in terms of people borrowing in the cheap to fund currencies like won or yen and buying higher yielding currencies such as the Mexican peso or the Brazilian real and things of that nature. And that was kind of being a trade that a lot of folks are talking about. And it's something that's just on the little back of my mind. I'm always a little bit worried about it. And if I was sitting there and I was a big, yen bear, I would be worried about the amount of people that are doing that trade, because the thing about those sorts of carry trades is that they come off quick.
Yeah. And they can be very violent the other way. Anyway, so number one, Kev, was just we have the inflation numbers coming out next week, CPI, PPI. And obviously, inflation generally has been backing off, but it's got stubborn here in the last little bit. Do you have kind of a thing that you think that inflation number stays stubborn, or do you think it still keeps mean reverting?
Well, I think that it will continue to mean revert. The real question is, will it start to outperform on the upside versus the lowered expectations? And for those who talk about the inflation numbers and they say, well, look, it's falling. We're down from whatever it was down to, like, let's just say we're down to 4 to 3. The real question is, but is 2.5 already priced in?
Yeah.
And if 2.5 is already priced in, the 3 could actually be a surprise to the upside. And I think that we're at a point where if it's not this month or next month, but we're approaching a point where if these commodities start to, stop going down and things, turn a little bit here, that we could have a situation where inflation will start ticking back up.
Yeah.
I would be worried about it. And I'd be careful if I was a big deflationist.
Right. Right. Okay. So let's just hit the charts and see whether my ship sinks here, buddy. S&P 500. What I thought was interesting was the pop and drop through today on the intraday basis. Now, I am reluctant to already in any way say that this advance is over. One of the things that I've been pretty adamant about is just identifying the most basic element, which is S&P 500 is above all its moving average, above all its ascending trend lines. Every single Fibonacci level holds. The sequence of higher highs and higher lows remains intact. The fact is that no matter how much one can feel bearish, there is absolutely nothing technically bearish on this chart. And the question, did we see a little bit of weakness coming here in these markets? Is it just going to be what we saw repetitively in the last 4 or 5 months, which is it gets bought on dip and just rips again? One of the clues that I'm going to be watching is whether or not the 4,400 level holds. The Fibonacci zone's a little bit higher, but the point is that generally if it's bought on dip, we should see buyers come in early next week. If we see a breakdown below 4,400, I wouldn't call it bearish, but one of those periods where we have a 2 to 4 week pullback that gives back some of previous gains, which is a typical ebb and flow price action, may ensue on the other side of that. And so early into next week, I'm watching whether the buy on dip traders hold the line here. What are you thinking on the markets?
Well, so for those who don't follow Jimmy Jude, you really should, because the whole way for the past 6 months, he's been saying the market's going to grind higher and it's going to surprise everyone. And sure enough, it's played out almost exactly like he said it was going to. And what I love about Jimmy is that he didn't couch it and, say, if this, then that, and maybe it could go higher. He was like, no, it's going higher. You guys are all too bearish. It's going higher. And you got to just love him for that. And one of the things that he said was right before the breakout, back on May 27th, he tweeted out, 4,200 is going to be great support after we take it out. And that was before we had broken out at 4,200 and it was, it was sitting there below that level. And he says that he just retweeted something now. He says, you hated when I said this, but now you're praying for it, meaning that the 4,200 is going to be great support. Try not to bleep it up this time. And I kind of think he might be right that we might get a pullback at the 4,200 and we're going to, check this rally. And it just feels like back then, Patrick, there was nobody that was leaning long, and it was kind of an easier call in the sense that it was harder because you were so against consensus. But now it feels to me that it's almost okay to be long. And a lot of folks are kind of thrown in the towel and are now telling us why it has to go higher. and the market always seems to hurt the masses the worst. And I feel like that the pain trade might actually be down for the summer.
Well, you know what? I'm not opposed to that. I just want to see 4,400 given out before I'm going to tell you that that's actually happening. What I want to highlight is two observations that support your little thesis. Number one, when we look at the breadth of the market, this is just the New York Stock Exchange, how many stocks above 50-day moving average. I remember back in March, April, and May, we were talking about how bad the market breadth was. It was only the FANG stocks that were rallying. And we were saying that is bearish. And the only thing that could actually allow the market to have a meaningful advance is if the breadth widened. And it did. And we had the breakout. But that was actually a tailwind for the market to advance. But now that we hit the 75 level on the upper boundary, we're no longer... so like, I don't want to say oversold, overbought. That's not the metric of breadth. But generally, if you look, a lot of major market tops tend to swing highs in the markets tend to form after you approach this kind of 70 to 80 zone on the upper side. So suddenly we no longer have this as something that is a bullwind, but now it's actually a headwind. Now, the other thing that's interesting is to look at the fear greed index. I like the CNN money one.
I know you do like that one. I think you just like it because it moves fast.
Yeah, but it's
the Bank of America one is
pretty.
Nowhere near that.
It's just pretty. It's though. Anyway, the point though is that back when the regional bank crisis was going on in March, right? It was extreme fear reading. Okay. And everyone was so sure that this market was going to crash because of the thing. And everyone was bearish. Now the markets are up high, and we are at 2-year highs we came off of a 2-year high on the extreme greed reading on the other metric. The point is that back when everyone was trying to predict that the market was going to crash during the regional bank crisis thing, we are now virtually the exact opposite moment. Yeah. Right. And
it's never going to happen, Patrick. Because we're both kind of somewhat cautious now.
No, actually, I'm not. Look, I actually think that you cannot take off the table that this market goes for a full retest of its previous highs of 4,800. I actually, if 4,400 doesn't give out, there is every chance that this market makes one more screwed up move up. It doesn't mean that you're not going to be right that the summer will be in consolidation. It just means there's nothing. The market can still go higher. I want a little bit more evidence to be already tilting the other way. But one way or another, this market is on the upper boundary. I'm using a number of really interesting option strategies to hedge this out. One of the things I'm doing a webinar on is this the ratio back spreads, but I've been doing the calendared straddles, a number of different things. It's just a way of hedging out the risk that the market does turn. But this is still a very bullish chart, Kev. And we have to see when this really breaks on that front. What I want to move on though, let's talk interest rates and bonds for a moment. Like, it's a stock markets thing, but like this is where the crazy ass shit's happening. Let's start with the 10-year bond, and it's broken back down to 2022 lows. I mean, okay, it's not printing new lows, but look, we're right back down there.
But there's going to be a recession, Patrick.
So, well, no, but let's talk about this. This is now where I feel that the stock market itself is driving sentiment. And one of the interesting things to kind of think about. All right, so let's kind of talk ourselves through the foolishness of being bearish too early. So if you go Fed funds and you see where we are, go back to 2004 to 2006, right before the financial crisis, when Greenspan and then Bernanke finished off this rate hike cycle. They started in 2004. They ended in the summer of 2006, but we didn't see a recession until 2008. The point is, anyone who thought 1 year into a rate hike cycle that there was some imminent any day recession, I mean, a recession might not be until mid 2024. Like, there is no evidence that there has to be a recession right now. And I just think people are thinking. So now the fact that there was no immediate recession showed up, suddenly everyone went from hard landing to soft landing to no landing. And no better evident place in that is to look at the SOFR futures out to December 2024. Like when you go and look at monthly year, but if you go look at what we basically saw, we saw back in May them pricing 2.5% yields, essentially. I'm rounding. That the Fed was going to essentially already have cut 2.5% 18 months from now. Look, in 2 months, we've gone to now where it's trading just above 4%. Like, literally, they pulled all of the imminent recession rate cuts of the imminent Fed cuts right out of the market. Am I misinterpreting this?
No, it's because they thought there was a regional bank crisis and we were going to have a repeat of 08.
Right. But now I think it's completely gone, overshot the other way.
I don't know.
No,
I'm
listen.
not sure you're right there.
No, look, I don't think things were remotely as bearish as everyone thought it was with the regional banks. But I don't think it's anywhere remotely as bullish as everyone's making it right now. I think it's somewhere in the middle. It's like a Goldilocks porridge testing thing, right?
Like that, Patrick, is that because the curve is so inverted, that this decays against you. So you could be right, but even just the status quo, all these things go much lower. Right? Like the June contract.
How much lower? Of 1 point.
94.77. So
yeah,
that means
so like
that
1
if
point
nothing changes, Patrick. Let's just imagine he goes on a hold for the next 2 years. This contract goes another 100 basis points lower just because of nothing happening.
Oh my God, I'm totally a seller on that. Like, okay, look, anything can happen, and that is a risk. I'm not going to say it's not a risk,
but that's why those things are trading like that, is because most people sit there and go, no way, he's going to lower rates. He's going to lower rates because there's going to be a recession and they're going to lower rates. And so, but the real question you should be asking is that priced in? What is priced in?
You know, the funny thing is, okay, we had the jobs numbers, right? And everyone's staring at the jobs numbers, waiting for the crack. But, you know, the interesting thing is, go think back to the subprime crisis and all of the shit that was going on in 2007, the Bear Stearns credit hedge funds blowing up in the middle of 2007, all of that shit happening, and recognizing that the jobs numbers didn't start to spike until the end of the first quarter of 2008. The fact is that the jobs numbers held right in hindsight 3 months into a recession before the jobs numbers broke. The fact is that nobody. Everyone's looking at this data like any day now, this shit's going to signal and give the evidence of that thing. But I honestly think that things, when the Fed raises 5% in fucking just over a year, no one knows the true impact of such a dramatic interest rate hike. And the thing is, I think we've gone from one extreme where everyone thought it was going to be a disaster to now everyone thinking all the danger has been averted. And I think that it's somewhere halfway in between. I'm neither.
Listen, that could be. I'm not going to disagree. I think that there's elements that are already showing up of the economy weakening. The question whether that's going to, if we get let's just imagine we get a slowdown. I don't know if the market is going to do what everyone thinks it's going to do, because I think a lot of that's already priced in.
No, I disagree.
Yeah,
I disagree. The stock market is freaking a stone throw away from its all-time high. Yeah, the fact is that the market is so high. Think about it. The stock market, okay, we saw yields on the 10-year treasury rise how many percentage points? There, at some point, interest rates are discounted into multiples and valuations. We're talking about
that's not quite true. If you go look at multiples versus interest rates over the long period, the relationship is tenuous at best. And so you're sitting there saying that, like, we're trading at 19 times earnings. Yeah, it's high. Like, there's no doubt about it, but it's not like it's obscene.
I'm sorry. You at some point, you give investors genuine alternatives, which is at some point when the valuation gets high enough, everyone can go and buy 5 to 6% paper and lock in.
Why are they doing it already? Why are we getting this rally?
Well, the fact is that because this is the liquidity cycle, which is everyone is being forced to participate.
But why? But the smart money being forced to participate? Why don't they just go earn 5% in overnights?
Oh, because of career risk. They have to be in the market here. But
was on Bloomberg. He's saying I can buy good corporate paper for 6%. It's already there. So according to that logic, it shouldn't rally at all.
Oh, no. It will be, I honestly think it will be a ceiling on the market, 100%. It's going to be, as this market, right now, the market has momentum. And when a market has momentum, everyone grabs a gamma, they go out there and grab equity. And as soon as this market gets heavy, I'm not talking about selling, I'm just talking about it stop going up. The fact is at that moment, when people see that there is no more gas in the tank for this to advance, the rotation back into this high-yielding paper is going to happen with a vengeance.
But it's not high-yielding.
What do you mean 5-6% is high?
The long end is already, the folks have already plowed into the long end because they're all
not the long end. Why would someone go into the long end when you think the stock market is expensive? Why wouldn't you grab 5-6% paper?
And you think that generally that's been the play, because what will happen is the Fed will lower interest rates, and therefore you want to extend out the curve.
Okay, no. Listen, there's those people that are playing the upside potential of a bond rip based on a cut cycle. But I'm talking about simply the opposite of Tina, which is there is an alternative. And when you can sit there and reduce equity exposure into cash.
That's already occurring. And that's why we didn't rally. That's why everyone is being bearish.
I think people are being forced to go long. I don't think that's as bearish as you think.
Could be. I don't want. Listen, I just told you I think we're headed lower, so I don't want to argue the bull side too much, because I do believe that we're a little over our skis and that the next move is probably going to be a lower one. But I just don't know if the reason for that is going to be because all of a sudden, like, the front end is yielding 5%. It's been up here for a while. Yeah. Nothing's changed.
Well, anyway, let's move on. I want to talk about commodities and a couple other things. Otherwise we're gonna beat this too much. But
can we actually talk about one thing though before we do that? Because in terms of kind of the recent action today, obviously it was huge. You've highlighted how the dollar sold off, and there were some big moves in terms of the stock market getting a bid again later, but it sold off. But the one thing that was interesting was the real action was yesterday. And it was in the ADP number. And the ADP number was a blowout. And all of a sudden you saw folks just wailing on it. There was Ed Bolingbroke, I think that's his name, from Bloomberg, was writing about all the big contracts. Like, someone was selling twos like they were going out of style, big blocks of twos, like as people were anticipating a more hawkish Fed. And we saw actually the 2% yield blow out to a new high, but didn't close there. But one of the things that I just want to highlight is that this was all based upon this ADP number. And my buddy, and I hope he doesn't mind that I use his line because it's just so good and he has to be attributed to it. My buddy Risha Mishra, I hope I said that right. He says ADP never fails to fail. Have complete faith in ADP to get it wrong time after time. And what I just think is so interesting is that just think back, Patrick, to yesterday's violence of the moves. How they were selling stocks. They were convinced that, the twos were breaking to new highs. And then today we get the employment number, the actual official one, and it's nowhere near there. And they have to give it all back. And it kind of feels like maybe yesterday was climactic in terms of people's worry about the Fed's immediate hawkishness. And going back, and one of the things that I think that people might be missing is that if we do get a soft landing, if we get a situation where the Fed actually manages to put this plane down without it crashing into the ground, then one of the things that might be mispriced is the long end of the bond curve. Because the long end is assuming that the Fed will go and be extremely hawkish at the front end, causing a big recession and a big kind of violent move back the other way. And if we get a situation where they put it down safely, then everyone might be sitting there going, oh, geez, I own way too many bonds.
Yeah.
Curve's really inverted.
The only, listen, you know what this reminds me of? When I hear you saying this,
God, you're going to talk about Chicago when I was early again.
Because you're going to be 2 years early. Look, the fact is that
come on, you told me this. You told me bonds were a great buy like 3 weeks ago.
I was just saying the lows were likely in, and I still argue that they probably are for the long bond.
I don't know. I feel like that folks they're missing the bigger picture about bonds. And the bonds could go down, even though they're down.
Those deflationists out there that think that we're going back to 0% interest rates, I think that
there are guys like that. I know there's famous.
There are, and I'm just saying
those are on that are based upon sub 1% kind of Fed funds futures.
Look, I am not opposed to the idea that we're not returning back to a disinflationary or deflationary period where we see a rip like that in bonds. But I honestly think that the next move where we see, 5, 6, 7% yields on long bonds is got to be on the other side of a cycle. And I'm not saying you're not going to be wrong. I just think that you might. I think we might be 2025, 2026 before you're right. No. I just think that it's not going to happen this year.
Well, that's what makes the market.
Right. Anyway, what I wanted to though just talk about junk for a moment. Junk technically broke down, but this is an interesting part is that this is not a breakdown by credit spreads blowing out. What shocks me is credit spreads on high yield. This is just the broad basket of high yields is still at 4%. Like obviously, when the yields broadly rise, all bonds are going to reprice, but there is simply no credit risks that are being priced in. And it's interesting. There's a number of people I know, like Jerome Blackland put out a tweet out there showing bankruptcy rates, or actually Simon White at Bloomberg did the same thing, showing the huge spikes in bankruptcy rates and credit spreads not yet reacting to it. The bigger question is that when you're so bearish on bonds, when do credit spreads and these junk bonds start to reflect it?
I don't know, but I do know that they'll do it ahead of any severe weakness in the stock market.
Yeah. And this is why, honestly, this is my canary in the coal mine, buddy. Like when we see a substantial break in junk, and particularly if it's reflective in a credit spread widening, not just trading in correlation with 10-year, or just in broader yields. I think that's actually going to be a really important signal, and certainly that's something I'm watching. But it's amazing that they're not worried about nothing. And you know what? Maybe it's the fact that junk has always gotten a strong correlation to equity. And so with equity holding up, junk has been able to just correlate. And do you think that that's just really one of the contributors to why it's been holding up so well?
Well, I think the junk's been holding up because the economy's holding up. And until we get problems in the economy, they're going to be okay. Why are you laughing?
All right. Okay. Let's talk commodities, buddy. All right.
But the economy has been doing well. It continues to surprise to the upside. Like, I don't know why.
Well, it's only surprising to the upside when everyone was unnecessarily bearish. I don't think it's that's
not true. Everyone thought that we'd have layoffs by now, and that this would
exactly. This is the whole point. Is everyone thinks the jobs numbers were going to break?
We heard once the Fed went above 3 that it was going to crush it in the economy. Then at 4, we heard it was going to crush the economy. 5 was going to crush the economy.
You're right that people in general were too bearish too early. I'm not going to
this time. The economy is going to be screwed.
No. I believe the same thing that I started this entire talking charts with, which is that back to that it's not going to play out the same as the financial crisis. It never does. It's not going to be like that. But all I'm saying is that the rate cuts stopped in 2006 and the recession was in 2008. Everyone is just looking for a recession way too early. I would not be even shocked if the recession didn't start until 2024. The fact is that it's just everyone is thinking everything is going to break too soon, and it's just going to be far longer, far wider. I think people have to get tapped more before things start to reflect in economic numbers. That's all I'm saying. Let's talk gold though. Will gold uptick with the dollar break? This is one of the interesting things. We've gone now through a 2-month retracement in gold, more or less holding Fibonacci zones. The descending trend line, let's use a really thick crayon here, and let's not sink this ship. But the bigger question, does gold break out here with some US dollar weakness? It's something I'm watching. You know what? Typically in the past, that inverse relationship of gold to the dollar has stayed true, and it'll be really interesting whether it stays true in this cycle. Right now, gold has not yet broken out, but it's certainly something for our listeners to watch as we go into next week.
From your lips to God's ears. I'm not going to comment.
All right. Next, crude oil.
Actually, a good close of the week, eh?
Yes, a strong close. Now, what was interesting, first thing I wanted to see is get back about 70, 71, which there was a little hourly fib zone. But we have seen oil start to strengthen. Now, I'm not yet super excited about this trend line break yet, because to me, the real tell is if we can see oil return back into the first quarter trade range, which is let's call it 74 to 82. It's subjective a little bit in terms of exactly where the range is, but most of the high volume node fair value zones lie in the middle of this trade range. And any rejections of crude oil from this area sends it right back down. And so I think it's very early to get super excited. But what I would feel is that after a 1 year, even longer than a 1 year bear market in oil, it's been a relentless bear market. And we have not seen a legitimate attempt by the bulls to turn this. And it'll be really interesting. I think it would be a very good positive if they got it back into this kind of 74 to 82 trade range. If they did, there would be a lot of chart repair. It'd get above a lot of moving averages. It would bring it to a lot of people's attention, and maybe that could be the condition from which it rallies. But the one thing I will say is this: if oil has been declining based upon an economic slowdown, and there isn't an economic slowdown, Well, what does that mean? Does that mean that oil is priced in a recession that didn't show up?
Yeah.
And so the question
100%,
is,
Patrick. The recession bros have been leaning on oil for sure.
And so the question for me, does it get back into this trade range? And if it does, I think it would be the first positive price action that we have seen in this thing in a bloody year. And let's see whether the bulls can pull it off. Is all there's a lot of work that is ahead, but let's see if they do it. The other thing that I want to highlight, it's been a nasty pullback in uranium.
Oh yeah. I was away and I didn't even notice.
I love Cuppy, but he came on with the Market Huddle Plus and he goochered it. he came on bullish as fuck, and it's been pulling back since. So I need to get him to come on and just say that I sold it all, just got out.
But he won't because he hasn't.
I know.
It's not happening.
No, but we love him. I listen.
Looking at the one of the things that I love to do is I love to trade it against the NAV.
Yeah, and is it a discount? It's got to be at a discount because
the reality is that almost all of the decline of this last couple of weeks has been just an expansion of the discount. We've gone from 5 down to
U308 though did drop $2, right? Like the U308 went from 57 down to
underlying. The underlying net asset value of U, and now I'm going to do this in Canadian dollars just because that's what I think. Yeah, it
was like a 4% decline in the U308, and it's been a 10%.
In June 13th, it was worth $19.22, and now it's worth $18.50. So it's the underlying's moved down 75 cents from the high. But meanwhile, the actual kind of U.UN has gone from 18 to 16. It's down $2. So there's an extra $1.25 that's purely just a widening of the discount to NAV. Yeah, you know what kind of pisses me off about this? I think that Sprott would be much better off selling underlying physical and narrowing this discount and making this much more like an ETF that follows it. Because one of the things is that if you're trading this now, you're getting kind of, let's just say, 10% moves that are nothing more than sentiment, as opposed to sentiment in terms of the premium or discount to NAV, as opposed to the actual move in the underlying.
Yeah.
So it would make sense if they would just go and make this much more like an ETF. And when it's at a discount, let's just say it goes to 5%, they sell underlying, they sell the U30, whatever, 08 or whatever it is, and they buy back their stock.
Yeah. Well, I don't disagree. But you know what, Kev, looking at the clock, I think that's enough talking charts for this session. Because we'll listen, we have lots to talk about next week. We'll continue this conversation then. All right. Time for skin in the game, buddy. You got me.
Yeah, you were bearish for a change.
Well, the pullback you're looking for now is the pullback I was looking for back then.
Yeah, you're always telling me that I'm early. Okay.
No. I listen. Hey, I was early. It is what it is. But listen, I got fooled into making a too strong of a bet because our listener upped us that it was supposed to be a 3-point.
That's right. Shamed us
into like betting hard, and now you widened the lead.
Yeah, 36-42. Okay, let me tell people about it. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode. We're playing up to 50 points, at which point we're going to take out 3 lucky listeners. And we have a new rule that we're not allowed to bet less than 3 points.
Well, actually, supposedly, isn't it next month that it goes to 4 points or something like it?
That's right.
We have to keep it escalating.
Okay, so now I have a question for you, because you've been talking about how we're going to have this episode next week. I thought that I was doing that one alone.
You probably are. Well, okay. So, well, listen. Let's no. Listen.
Be honest. Let's pretend you're going
to
be here, Patrick, and then you're.
No. Listen. I listen. Well, let's see what we can make happen. Okay, buddy.
No. But let's assume you're not here, and let's do this for a 3-weeker.
Okay.
Okay, because I think that's a much better thing, and we can do that trade.
Well, yeah, if I come on for some talking charts next week, we'll settle the bet still 3 weeks from now.
That's right. So the bet is for a 3-weeker. Now I had a plan about what I was going to trade, and both of us kind of had the same position, and I don't want to go through it, so I'm not going to trade that. And I decided that I just listened to your talking about the bonds, and I can't help it. So we're going to do the 10-year future. We'll do the September contract. Okay. And so we're going to settle this. It's the next time you'll be on the show is July 28th, if I've got my math right. Okay. So it's 3 weeks from now. I'm going to give you a 1-touch, 112 3/4.
You bastard. It's a little too high for you. Like I'm
1 touch, baby.
It's a little too high. No. I'll
do you want me to take it? Do you want me to move it?
No. Tough luck. It's the 3-point minimum. I'm taking it won't.
Okay. I guess I own that too. Oh fuck!
You went too high. Like
I went too high.
You went too high. Like if you did 112, I would seriously.
I'm used to working on the sell side and rip it off my clients.
So nonetheless,
I thought you'd price. I thought you just your view would overwhelm it. Oh well, okay. So I own.
Well,
it.
You know what? The funny thing is that we're gonna go like what the Fed meeting is the 26th. So we're gonna have 2 days of post Fed. Like it could be wild. But anyway, I took my side. I'm taking the it won't.
Okay.
So
112 3/4. I own the 1-touch.
You own the 1-touch. Let's see whether or not I make the comeback.
I was greedy. I put it in the calculator, and I was like, I knew I was being greedy, but I was too greedy.
All right. Let's quickly hammer some no stupid questions here.
Right.
All right.
Okay, so we got no Lena, so one of us is going to have to do
I'll read this first one.
Okay.
Love the show. The new Market Huddle Plus. What's your outlook on the TLT on a 2-year time frame? Oh my God, this is come on. Obviously, this is not a listener that actually listens to you. Yeah, please give us the bare narrative. How low is the TLT going to go, Kev?
1 second. It is going to go low. Like it's going to go really low.
In 2 years. In 2 years.
2 years?
Not 5, 2 years.
So I think that there's a better chance than most people acknowledge that we have a crisis like they had in the UK here in the US, or in the US, not here in the US. So if that was the case, like, I don't know, Patrick, like I really,
you are so bearish.
I know I am. I'm really bearish on those things.
So my view is a little different. My view is that there is going to be not a soft landing, but it doesn't have to be a doomsday hard landing. I just think we're going to have a proper a recession of some sort because the Fed was too aggressive. I think it will happen. During that time, I think over the next year or more, there's going to be the typical reaction at Treasury moves higher simply just because the Fed is going to have to cut, things are going to ease, there's going to be liquidity. But as soon as that cycle finishes, there could be another downturn. But 2 years, I don't think the TLT has to. The TLT
is a 20-year contract. Where do you think the Fed's cutting to?
2.5%. Like I think it'll cut in half. Right. So, but the point is that if the recession doesn't kick in, let's say the recession doesn't kick in for 6. Listen, just let me marry. If let's say it takes 6, okay, this is a 2-year time frame he's saying. So let's say the recession doesn't even kick in for 6 months. And then there's an easing cycle for, let's say, a year where they cut 2%. Then you're 18 months into a 2-year time frame. That's not going to be a period where the TLT is going to be at 80 or 70 bucks. Yeah, a 3 to 5 year time frame, you're right. I think in a 2-year time frame, there's nowhere near as much bearishness, and in fact, there's even room for TLT to have a proper rip on the short term in a reaction higher. That's my view.
The 20 year is currently 4.25, basically.
So it could go under 3. It could go under 3 in a bull period, in an easing period. And then the point is,
why would it go under 3 if you think that the Fed's going to go to 3?
Like all I'm saying is that it's not going to be remotely as bearish in the 2-year time frame. This is again Chicago all over again. I'm not saying that you're not going to be right over this decade. There could probably be a fucking bond shit show this decade, and there could be a yields could blow out through the roof. I just don't think it's going to happen in the 2-year time frame.
Okay.
Right? I just think you're early. Right. So let's get the second one here. I'm going to read this because you're the one going to answer
Huddlers,
this.
Love the show. I am long Brazilian real futures and wondering what options I have to generate revenue while holding my long position. And most importantly, what option would you use? What option? Oh, like this person wants to sell like options.
Yeah, he wants to try to
open all suggestions, selling options, spreads, whatever you can think of. Thanks a lot. Well, I'm not going to talk about selling options against this, but I am going to explain one thing in terms of you're already earning with the future, meaning that the carry on the real versus the underlying, against the US dollar, the interest rates are different. So every month you're actually earning the difference between those. So it is a positive carry position, just owning and holding this thing. And those prices are baked into the futures. Now, let me just see if I can pull the futures up. Real futures. Okay, here we go. I got them on the thing. If you go and pull up the chain, you'll see that if you look at the September contract, it's trading at 2038.5. And then if you go look at the December contract, is trading at 2014. And if you go look at the March, it's 1994. The June of 2024 is 1979. So those kind of increasing discounts is what is that kind of implicit carry in the position. And it doesn't matter whether you buy that it's kind of I don't want to say it doesn't matter. It does matter if you buy like a June 2024 because you've locked in that difference in funding, but you can also experience it by just continually rolling it. And it used to be that nobody cared about these things, but this is the hot trade now, is that everyone just loves earning the carry on these Brazilian real or the Mexican peso. And so that's that. But do you have anything that they should I can't even speak today, Patrick, suggest in terms of options?
You know what? I haven't looked at the chain, but look, I always love going out beyond one standard deviation and seeing where you could grab a little bit of theta. Anything that you can grab at that's when the currency is on the short term overbought or oversold, there's always some opportunity. But I think you have to truly have a legitimate trade plan to do it. You can't make the shit up as you go. You sort of have to have a technique or a methodology, and you have to stay on top of it. Otherwise, I would just leave it alone and just take the carry.
Yeah, I would agree. I wouldn't short the options. Yeah. And in fact, I think Jim Leitner is the opposite. He's trading these options just because he loves the carry and it's implicit in there, and he's long the vol as opposed to short. So there's one of the greatest traders around.
Yeah, for sure. I'm going to skip to the fourth question because it is actually about the carry. So let's just see if we answered it or not, and
Okay, so you want me to do it? Or you want
well, here. So the longtime listener of the show, love the beers, humors, and discussion. The question is around carry on currency positions. How is the carry determined and calculated? And as a retail trader, where can I access the carry info apart from calling up a bunch of banks? Keep up the great work. So maybe we can give them a primer.
You don't need to call up any banks.
Yeah.
All you have to do is look at the chain, and you can see, you pull it up and you can see the different prices based upon where it's trading in the spot market and where your future is trading.
And so let's just,
and that's all it is. And that's in essence the carry. And it's one of these Brazilian, let me just pull this up. So if we just look at, let's just take a really short term example. So the August contract is 2044 at 45. Okay. And if we go look at the actual Brazilian real, you'll see that it's not trading because it's 5 o'clock on the stuff, but let's just go and do the math. And unfortunately the CME does it the other way. So we have to go backwards, but it closed at 4.8719 and we got to go one, and we get price.
The suspense.
Yeah.
The listeners are, what number?
20.52. So you'll see that there already is that carry. If you're long the future, you go long the real, then you're going to earn that extra. If nothing else changes on the currency, you're going to earn,
you're ahead by that
0.08 over the next whatever until August expires.
Yeah.
And all you have to look at is here, like, let's just take a year from now. A year from now, you can buy the December 2024 contract at 19.45. So that means that if nothing happens, if it just stays flat, you're going to go and you're going to earn in essence $1 on 1945. And so that difference is what the carry is. So in terms of, you don't need to go calculate it. It's usually implicitly in the futures contract. And one of the only thing I will end with in terms of the retail trader is be careful if you're trading contract for differences or if you're going and actually trading the spot, because you won't earn the same implicit rate that is in the future, because you won't, how like balances, unless you're trading, $10 million, you don't get the same funding rate as someone who's as a bank. So you're often better off on these sorts of products of trading the futures, because it ends up being more efficient, especially if you're holding it over the long period of time.
All right.
Okay, let me do this question. Great show. I have 2 questions. Alf screens trades by asking about correlations. When the shit hits the fan, everything goes to 1. So in a world where most risk assets are highly correlated and 60-40 is dead, how should we determine when you have too much correlation in a portfolio of trades? And then quants and AI seem to be eliminating any edge from TA. Well, Patrick would tend to differ. Does this mean that we all have to become options math or fundamentals experts to find any edge? Do you want to just start with the first one first, or the second one first?
Let's do the first one first, which is correlation of trades. What's your thoughts?
Well, in the past, the 60-40 hasn't been dead because the correlation between stocks and bonds has been quite negative. And even when the shit hit the fan, it actually, instead of correlations going to 1, they went to -1, meaning that in times of extreme stress, when the stock market went straight down, the bond market would go straight up. And that has traditionally been one of the go-to trades. And even now, many people don't believe that has gone away. And there's lots of folks that are buying fixed income because they think that there's going to be some sort of market event, and they think that correlation will continue. But there is no doubt that at least 2022 showed that there are times when that correlation isn't negatively isn't negative, and in fact could be positive. And in that case, it's much more difficult to create a portfolio. And so one of the things that you might want to look at is other things like gold, inflation break-evens, commodities. Just because all correlations go to 1 doesn't mean that aren't some in there that are still going to go to -1. I would argue that gold would probably be one that would do well in the times of of extreme market stress. Would you agree?
Right. Listen, all of the things you're saying, I agree. But my framework is completely different because I hedge out all tail risk with derivatives and options, right? So for me, I like concentration. I like owning less assets, and I simply try to remove those left tails and pay for it. Obviously, it's not
Right.
zero cost to do it, but I just have a different way of approaching it. So I mean, you're referencing some. I think it all depends on your size, right? And you're throwing around some billions. You can't go and use the options market the same way as retail investors can. And so I think the more you are, the more you're like a pro trader trading huge size, the more you have to lean towards your diversification kind of approach. And the smaller you are, the more there are alternatives that you could consider. So,
yeah, and the other thing is be careful when you go and start listening to everyone that's leaning one way, because what you'll find is that that consensus, even though you'll think you're really smart and that you'll be like, oh, I've got this portfolio that's so different than everyone else's. If you end up listening to the same folks, a lot of them will have the same trades. And in fact, I've read many things where market, wizards have said, I've gotten out of the New York kind of scene because I found that I was, getting sucked into the same trades as everyone else. Yeah. And one of the greatest ways to make sure you're not too correlated is to make sure you don't have the same portfolio. So that's true. Work hard on finding different types of ideas. Work hard on kind of trading different products, trading things that aren't the kind of popular trades.
Well, Kev, you know what? This is a moment. I'm just going to make a selfless, a shameless plug for a webinar I'm actually doing. Anyone that wants to join it can go to bigpicturetrading.com/money. But I'm actually going to be talking about the backspread strategy as a way of hedging out left tail risk. And I'm doing that webinar on Tuesday, and so on July 11th. So anyone who wants to join, it's bigpicturetrading.com/money. I had to squeeze that in there, Kev. Sorry
no
about
problem.
That.
You're a real trooper. You do all these things. And that other podcast.
Listen, anyone who wants to check out how to use options, join me for that. Anyway, but let's hammer the second half, which is quants and AI seem to be eliminating the edge of technical analysis. So before we read the second half, I want to just highlight this. I think that this is true for the shorter time frames. The more you are a day trader, the more you are trying to compete with very short-term order flow, the more this is true. But the reality is on any larger time frame, trends exist, and technical analysis identifies those trends. Like, for instance, the S&P 500 has been in a multi-month relentless trend, higher highs, higher lows, above all its moving averages. There is nothing that quants and AI is eliminating from observing the technical trend that's been in place for months. The fact is that it's all about time frames. And I think the point that he's making is that when you're trying to day trade and compete against machines managing order flow, then you're going to get chewed up a little bit. I'm not going to push back on that, but there is still lots of opportunity to use technical analysis when you just widen your time frame a little bit.
Well, I'm going to take a slightly different approach to this, Patrick, because I'm going to say that I think that they've changed the nature of trading. Would you not agree?
Okay.
Like that it's kind of sped up cycles. There's been more false starts. It's changed technical analysis. All these,
but is it quants and AI, or is it actually social media? I actually think the fact that we're
a lot of quants and AI. I do believe that there's more and more money that is being traded on that perspective, but I don't think that makes technical analysis any less valid. And even though I like to give you a hard time about it, it is important. And I think that if you listen to guys like Paul Tudor Jones, I think he had a quote, something of the lines of the problems with the markets is that all these traders have kind of overly relied on computers, and they're kind of abandoning, or they don't know the basic rules of technical analysis. And I think that if you would talk to Paul Tudor Jones, he would say that in fact it's becoming more important, not less.
Fair enough. I agree with that statement somewhat. I've not see like a big picture trading, hence the name. I'm not into day trading or short term trading on that, and I don't see that I've been kind of like when I do my chart forecasting and looking at stuff, things still seem to follow all of the rules that have worked all along, and I'm not seeing that stance that our listener submitted here playing out on those longer term charts. Anyway, listen, anyone who has questions for Kevin or me, you can submit those questions at nostupidquestions@markethuddle.com. Kev, that's the show, buddy.
That's the show.
What the heck? We wrapped it up here pretty quick. Well, I mean, obviously we didn't have a guest, but
let me do my outro and then we can talk and we do the beer. Thanks for tuning into the Market Huddle. We appreciate you spending some time Please give us a follow on Twitter at the Market Huddle. You can listen to the Market Huddle on all the networks. You know the drill. Patrick, where can they find you?
Bigpicturetrading.com. And for that webinar, bigpicturetrading.com/money. And you can also follow me. It just had to be something that people could remember. So anyway, and Monday. But you can also follow me on Twitter at Patrick Sarasna. Kev, where can they follow you, buddy?
You can go check me out at themacrotourist.com, and you can come to themacrotourist.com/chat, where we can join our little group of folks that love to talk about the markets. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the after show.
Okay, all right, Kev, let's start with this beer. Yeah.
It's too like butterscotchy or something.
Really?
Yeah, I'm not like.
My problem was I was done. But my problem was I was done the beer in the first 15 minutes, and I was thinking about how I can get this show to pause for a moment for me to get another one.
The smooth Scottish beer with hints of toffee, vanilla, and oak. So, I'm half Scottish, and you think that I would like stuff like this. It's just like the bagpipes. I can't stand the bagpipes, and I'm sorry if I'm insulting my homeland folks. I don't get it. And I'm kind of in the same camp with here. What are you going to give this beer?
I'm actually pretty good, buddy. I'm going to give it a 7.9.
I'm giving it a 6.1. I appreciate it. Like I'm not going to give it a really bad score because I can tell it's smooth, but it's just it's too creamy.
Oh, there you go.
It's just not like it's not really a beer. It tastes like they say hints of toffee. It basically is. It tastes like I'm sucking on like a...
All right, I can't hear anymore. I'm just going to stop. But Kev, let's change the topic. I need to know, you've been on the other side of the world. You went to Japan. How was your trip, and what did you find interesting out there?
So, yes, we went for 2 weeks. It was a once in a lifetime experience. It was awesome. The people are super kind, friendly, with me bumbling around, not knowing, like I know 2 words of Japanese and I speak them terribly. And it was just fascinating in terms of experiencing different culture. I came back with the.
Are the hotel rooms really small? Is it still a thing?
No, it wasn't as bad that. I was shocked. I guess, if you were to say what kind of surprised you, I was shocked at how much they follow the rules. Like we just like New York City, Toronto, wherever you go, we barely follow the lights. Like when there's people crossing and walking, like we'll be lucky if people follow it. There, like it'll be the middle of the night and the light won't say green for walking, and they won't. And I guess, if you have that many people in one place, you need to follow the rules. Otherwise it'd be chaotic. And I kind of get it, but they're just shocking. They must just think we are just like bores.
Yeah, I would.
They must come. I mean, like Toronto or New York, and go, "Oh my God, this is just madness. These people are crazy." They must. And did
you hit some sushi?
Oh yeah, we ate a ton of stuff. Like we really tried to immerse ourselves. Like in Tokyo, we stayed in the Shibuya district. I hope I'm saying that right. Like, which is kind of like not a big tourist place. I love Tokyo. Actually, it was awesome. As I said, we were kind of more in the area where real people from Tokyo go. And like Kyoto was lovely, but there was too many guys that looked like me, and it was kind of more touristy. And so I think we took one cab, and otherwise we were subwaying around like locals and trying the sushi, trying a million stuff. I tried eel. We really did try to immerse ourselves in it.
And it was awesome.
It was awesome. I just, super nice people, awesome experience. It really is just though, like it's another world. Oh, another thing. So a lot of times the hotels would not have any English channels. Like they might have CNN, like if you're lucky. And so I got kind of addicted to Japanese game shows. And they're awesome. They're just so much going on. Every single show, there's like 3 people up in the corner just doing visual reactions, Patrick. Like I didn't know what was going on because it's not like there was any sort of translation going on. I saw this one thing where this young woman had to stack milk carts and get all the way to the top. Like, so she's stacking like 25 milk carts. The suspense, the amount of like visual stuff going on around here is like all these different people are on the sides with their, it's just awesome.
That's awesome.
Yeah, no, it was a lot of fun. It really was. And we had a wonderful time, and we went around, and it really was a great experience for our family.
Oh, that's awesome.
Yeah. So how about you? What do you...
nothing new for me, but nothing. No. I have nothing to say. And we don't have Lena to save the day, so we're going to have to wrap.
Why don't we just call it a night?
Yeah. Anyway, thanks to all the listeners. We're going to try to get our schedule back in. And
we're not going to try. It's going back. Next week is a regular guest, and then from then on, it's every second week again, regular guest. We'll spice in some MH pluses while we can, and thanks for tuning in.
Thanks for tuning in, everyone. Thanks.
Take care. Bye-bye.